You want to pick the right dividend ETF, so you open a few tabs. Soon, you're drowning in data, comparing yields, expense ratios, and holdings across a dozen funds. You just want a clear answer. This video provides it. 9 elite ETFs distilled for building long-term wealth. The goal of this video is simple, to give you that clear answer. I'm going to cut through all the noise and focus on what matters. I will break down 9 of the best buy and hold dividend ETFs available today, analyzing each one on its core strategy, its historical performance, and the specific role it can play in your wealth building plan. And stick around through the entire list, because at the end of our final breakdown, I'll reveal which 3 of these funds I personally own to build the dividend portion of my portfolio. First on the list is the Schwab US Dividend Equity ETF, ticker SCHD. Its objective is to track the Dow Jones US Dividend 100 Index, which is composed of high-quality companies with a history of sustainable dividend payments. The screening methodology is strict. To be included, companies must have paid dividends for at least 10 consecutive years. From there, they are ranked based on 4 fundamental metrics: cash flow to total debt, return on equity, the current dividend yield, and the 5-year dividend growth rate. This process is designed to filter for financial strength, not just high yield. The key data is compelling. SCHD has an ultra-low expense ratio of 0.06% and has delivered a 10-year annualized return of 10.58%. Its dividend yield is substantial, typically ranging from 3.50% to 4%. For resilience, its maximum drawdown during the 2022 market decline was negative 17.81%. Its top sectors are currently energy, consumer staples, and healthcare, with major holdings like the Coca-Cola Company and Verizon. Next is an ETF focused not on the highest yield today, but on the potential for higher yield tomorrow, the Vanguard Dividend Appreciation ETF, or VIG. This fund tracks the S&P US Dividend Growers Index. Its core requirement is that companies must have increased their dividend for at least 10 consecutive years. This strategy operates on a simple premise. A company with a long track record of consistently raising its dividend is likely financially healthy and has a durable business model. This focus on dividend appreciation is a powerful quality screen. The data supports this. VIG has an exceptionally low expense ratio of just 0.05% and has produced a 10-year annualized return of 11.52%. Its dividend yield is more modest, typically below 2%, which is a trade-off for focusing on growth. During the 2022 market decline, VIG experienced a relatively mild maximum drawdown of negative 21.23%. The portfolio is heavily weighted in information technology and financials, with top holdings like Microsoft, Apple, and Broadcom, proving that dividend growth is a key strategy for today's market leaders. We've covered quality yield and dividend growth, which are core long-term strategies. But what if your primary goal is generating the maximum possible income right now? The next fund uses a unique options-based strategy to produce massive yields. For investors in or nearing retirement, maximizing current income can be the top priority. This is the exact problem the JP Morgan Equity Premium Income Fund, ticker JEPI, is designed to solve. Unlike the other funds on this list, JEPI is an actively managed ETF. It doesn't track a passive index. Its managers build a defensive equity portfolio of low volatility, high-quality S&P 500 stocks. But its core feature is the options overlay. JEPI generates a significant portion of its income by selling call options through instruments called equity-linked notes, or ELNs. This strategy creates a high monthly income stream, but it also caps the fund's upside potential during strong bull markets. The goal is to provide a high level of income and achieve returns similar to the S&P 500, but with lower volatility. Because it's actively managed, its expense ratio is higher at 0.35%. Its main draw is the high dividend yield, which often sits above 8%. Since its inception in May 2020, it has delivered a total return of 11.84%. During the 2022 bear market, JEPI demonstrated its defensive nature with a maximum drawdown of just negative 18.4%, according to TradingView data. If you prefer a more traditional passive approach to high-yield investing, the Vanguard High Dividend Yield ETF or VYM, is a foundational choice. This fund seeks to track the FTSE High Dividend Yield Index. The methodology is straightforward. It invests in U.S. companies that are forecasted to have above-average dividend yields. This results in a portfolio heavily tilted towards large-cap value stocks, mature, established companies known for returning capital to shareholders. VYM's primary appeal is its simplicity and low cost. The expense ratio is a rock-bottom 0.06%. It has a long track record, delivering a 10-year annualized return of 9.74% and a return of 8.52% since its inception in 2006, a period which includes the global financial crisis. Its current dividend yield is 2.63%. The sector allocation is what you'd expect from a value-oriented fund, with financials, healthcare, and consumer defensive stocks making up the largest weights. It's important to note that its underlying index excludes most REITs, so its exposure to real estate is virtually zero. Top holdings include Broadcom, JPMorgan Chase, and ExxonMobil. For investors who demand the absolute highest standard of dividend reliability, there are the dividend aristocrats. The SPDR S&P Dividend ETF, ticker SDY, tracks the S&P High Yield Dividend Aristocrats Index. The requirement for entry into this index is one of the strictest in the investing world. A company must have consistently increased its dividend payout every single year for at least 20 consecutive years. This long-term track record is a powerful signal of a company's financial stability and its unwavering commitment to its shareholders. This focus on elite dividend royalty comes with a higher expense ratio of 0.35%. The strategy has proven its worth over time, delivering a 10-year annualized return of 9.26% and an 8.79% return since its inception in 2005. The portfolio is heavily weighted in defensive and cyclical value sectors like industrials, consumer staples, and utilities. During the 2022 to 2023 market decline, its maximum drawdown was a modest negative 12.43%. Top holdings include established dividend aristocrats such as Realty Income, Chevron, and Kimberly-Clark, companies that have weathered multiple recessions while continuing to raise their dividends. The iShares Core Dividend Growth ETF, DGRO, represents a more modern approach to dividend investing. It tracks the Morningstar U.S. Dividend Growth Index. While it also focuses on companies with a history of increasing their dividends, its requirements are less stringent than an aristocrat fund. This flexibility allows it to include a broader universe of companies, particularly in sectors like information technology, where many firms have only become dividend growth powerhouses over the last decade. The objective is to provide a balanced portfolio that captures both current income and future capital appreciation potential. With a very low expense ratio of just 0.08%, DGRO is an excellent, low-cost core holding for a dividend strategy. It has delivered a strong 10-year annualized return of 11.56%. Its portfolio composition reflects its modern approach, with financials and information technology being its two largest sector allocations. This is evident in its top holdings, which include tech giants like Microsoft and Apple, alongside financial leaders like JPMorgan Chase and established consumer brands like Johnson & Johnson. During the 2022 market decline, DGRO had a maximum drawdown of negative 18.63%. The Fidelity High Dividend ETF, ticker FDVV, offers another unique spin on income investing. It tracks a proprietary Fidelity High Dividend Index, which is designed to reflect the performance of large and mid-cap companies that pay high dividends and are expected to continue to do so. What makes FDVV particularly interesting right now is its sector composition. Unlike many dividend funds that are heavily weighted in defensive or value sectors, FDVV has a very substantial allocation to information technology, currently over 24% of the fund. This positioning allowed it to post strong returns during recent years when tech stocks led the market. Its expense ratio is a competitive 0.16%. The fund's dividend yield is 3.79%. A powerful 15.6% 5-year annualized return is largely driven by its tech exposure. You can see this clearly in its top holdings, where Nvidia, Microsoft, and Apple collectively account for nearly 16% of the entire portfolio. This makes FDVV a sort of hybrid fund. It's a high dividend strategy with a significant growth engine attached. During the 2022 market decline, it experienced a maximum drawdown of negative 20.25%, a reflection of the volatility that comes with that tech concentration. The First Trust Rising Dividend Achievers ETF, ticker RDVY, focuses on dividend momentum. It's not just about a long history of payments, it's about recent accelerating growth. The fund tracks the NASDAQ US Rising Dividend Achievers Index, which screens for companies that have increased their dividend value over the previous 3- and 5-year periods. The index also requires companies to have positive earnings per share, adding a layer of financial health to the screen. The strategy aims to identify companies with strong fundamentals that are actively accelerating their shareholder returns right now. This unique focus results in a distinct portfolio. Its expense ratio is higher at 0.48%, and its dividend yield is 1.66%. RDVY has produced a strong 10-year annualized return of 12.3%. The fund is currently very heavily concentrated in the financial services sector, which makes up nearly 40% of its holdings. This is reflected in its top positions, which include a number of insurance companies like The Hartford and Chubb, alongside payment processor Visa and industrial manufacturer Snap-on. This fund is a targeted bet on companies demonstrating strong, recent dividend growth. Our final fund is a specialized tool for investors whose primary goal is generating income, the iShares Preferred and Income Securities ETF, or PFF. This fund is different from all the others on this list because it doesn't hold common stock. Instead, it invests in preferred stocks. Think of these as hybrid securities that have characteristics of both stocks and bonds. They pay a fixed dividend, much like a bond's coupon payment, and that payment has priority over the dividends paid to common stockholders. This structure makes them an attractive, though not risk-free source for high and consistent income. PFF tracks the ICE exchange-listed preferred and hybrid securities index. Its expense ratio is 0.46%, and its 12-month trailing yield is a substantial 6.64%. Because banks and financial institutions are the primary issuers of preferred stock, the fund is heavily concentrated in the financial sector at over 69%. This means its performance is highly sensitive to the health of the financial industry and, crucially, to interest rates. When rates rise, the value of existing lower-yielding preferred stocks tends to fall. This was evident in 2022, when PFF had a negative total return of negative 18.37%. And now, to fulfill the promise I made at the beginning. When building the dedicated dividend portion of my portfolio, the 3 ETFs from this list I personally own are SCHD, DGRO, and FDVV. Here's the logic behind that specific combination. SCHD is my quality income anchor. It provides a strong, reliable dividend from some of the most stable companies in the world by screening for financial health. DGRO is my growth income engine. It targets companies that are actively increasing their dividends, capturing future potential in a balanced way. FDVV is my tech growth kicker. It provides a significant dividend while also giving my portfolio heavy exposure to the growth potential of the technology sector, acting as a hybrid growth and income play. By combining these 3, I get a dividend strategy that covers quality, balanced growth, and a targeted tech tilt, delivering both cash flow now and multiple avenues for that income to rise in the future. You now have the data on 9 excellent long-term ETFs and the 3-fund strategy I use for the dividend portion of my portfolio. The right choice always depends on your personal financial goals. If this breakdown provided you with clarity, subscribe for more straightforward, data-backed investing content. Let me know in the comments which of these ETFs you own or are considering.